So it's time for the most popular video series that I do on the channel, which is the stocks that I'm buying in October 2023. I cannot believe we're already in October, but this is the most popular video series I do on the channel every month, where I go through the stocks that I'm going to be buying. I have been buying these stocks from the 1st of September to the 1st of October, and I do this video every month so you guys can track what I've been buying, what I've been selling, and as always, I will do my UK one in a few days' time as well. So I hope you enjoyed the video. It took a while to put it together, so if you could hit the like button, if you're new around here, subscribe. Let's get started. And as always, if you do want to see my live buy and sell alerts in real time, the place to be is on the Patreon. Join through the link in the description. I also have a Discord with 500 members on to talk to about stocks on there, including myself, and as well as that, I post 2 exclusive videos a week. So if you do want to support the channel, the link is in the description, only £5 a month. I am going to have the weekend off this weekend. I'm not going to post any videos on YouTube, but I will be posting 2 videos on the Patreon. So if you do want to see them exclusive videos, join through the link in the description. Let's get started. Number 1, Hims and Hers. It's back on the list. I cannot believe Hims and Hers is back on the list, but the share price has fallen massively, and I'm getting another fantastic opportunity into Hims and Hers. We've not seen this fantastic opportunity for a long time. We've not seen $3 since May time 2022. In the back end of 2022 November time, we did hit the $4 range, and then Hims and Hers actually joined the 100% return club from there. The stock went absolutely ballistic through the start of 2023. Since then, it's had a major pullback since May 2023, and I really like Hims and Hers at $6, and I have been buying shares once again, because in my opinion, this stock already right now should be a $10 stock. And then that's not factoring in the next few years, this stock could be a major company. It's a pretty small market cap at 1.3 billion, but this company has just come off fantastic earnings. This company continues to execute to perfection. I actually normally do a review of earnings of Hims and Hers on my YouTube channel, and every single time I'm giving them 10 out of 10 earnings. If you look at the last earnings, they actually beat by EPS by 0.01. They grew 83% year over year. Beat by 2.94 million. They hiked up their outlook, absolutely amazing. And then you look at how the stock reacted. On the day these earnings came out, in the last earnings, the stock was actually up 13%. And then it's given it all back since then. You can actually pinpoint since the last earnings. And since then, the stock has fallen another 14+% for no reason. It's one of the most frustrating stocks, because I've seen this company execute to perfection, 10 out of 10 earnings, and yet it's been going down. So you know what, Mr. Market, if you want to be stupid and give me these shares at these sort of valuations, I'm going to buy them. Now, if you have a look at what Hims and Hers do, they are a telehealthcare company that are trying to disrupt the healthcare in the US. They're trying to make it a little bit more cheaper. One of the big things with the US healthcare is obviously affordability. The other thing is convenience. As well as being cheaper, can you get 24 access? You don't have to travel to go get this healthcare. You don't have to travel to get this healthcare access. And as well as that, the younger generation, they'd rather do things online. They don't want to go see a doctor in person. They would rather do it online in the comfort of their own home. So you're tackling loads of issues with this company. Cheaper, more accessibility, and also convenience, and the preferred way of getting healthcare through a mobile app, and being able to stay at home and do it. Now, when you look at the company, they've got a few markets that they're in. They're actually moving into the weight loss category. But when you look at these market size that they're looking at moving into, every time they go into one of these categories, you look at primary care, 280 billion category. You look at sleep, 15 billion category. They've got all these categories to expand it into the healthcare. They're only just scratching the surface. And people worry about competition. Well, yeah, if they get competition in one, let's say they get competition in anxiety and depression, there's still all these other categories they have to expand to themselves. There's such a big TAM to be in is the healthcare space. And they've done this through 74% subscriber growth, 83% revenue growth, now up to a 12% adjusted EBITDA margin growth, 90% reoccurring revenue, 75% gross margins, and the payback period is 1 year. And you look at the long-term targets, there are targets to get to 20 to 30% adjusted EBITDA margin, gross margins in the 70, which is amazing, and 2025 targets of at least 1.2 billion and 100 million of EBITDA. Now you've got to imagine, 2025, we are only really setting off now a year and 3 months until we get into 2025. We are not that far off there, and I've got to say these targets are a little bit lowballing. I think they're going to be higher than this. And actually on the recent conference call, Andrew Dunham actually came out, and he's the founder, and he said that they probably need to update the targets at some point because they're probably going to easily beat them. You talk about 100 million in EBITDA, that's 13 times EBITDA for a company growing at 80%. That is absolutely insane. And then you start talking it's about 1 time sales for a company at 80% revenue growth. I've never seen this before. I've never seen a company trade this low for the financials they're doing. And you can actually look here, the company is going to come off 80% growth. Unless they're forecasting the growth to slow down next year a little bit, I think they're going to come up and they're going to hike this up a little bit. I think the low ball in this profitability, I think with 70% gross margins, your adjusted EBITDA margins start pushing 20-30%. You could be talking where the company is realistically in 2025, in my opinion, more towards 1.5 billion. And then you start talking, if you start sticking a 10% profit margin on that, you could be throwing off about 150 million in profitability. When you're at 1.3 billion market cap, with 150 million in profitability, you're trading at like 8 times earnings for a company at that sort of growth rate. It's absolutely insane. Absolutely insane, these levels that this company is trading at right now. You look at the financial health of the business, absolutely amazing. There's no debt on that balance sheet. And they sit on 193 million of cash. And as we know, they were a company that were loss-making and they're now adjusted EBITDA profitability. The profit will ramp up in the next few years. It's really exciting for Hims & Hers, so I am buying some more shares in Hims & Hers. Next one, Mercado Libre. So I really like Mercado Libre. I've actually been trying to make it one of my aims to get Mercado Libre up to one of my biggest holdings. I've kind of got, I think it's around 6th or 5th, and that's where I want it to be. I want it to kind of be a bigger holding in my portfolio. I think this is a mega company in the next few years. And whether the company does have a little bit of dips, if it ever has a dip, I do pick up the shares, and that's what's been happening with Mercado Libre. Now, if you don't know Mercado Libre, basically they are the Amazon of Latin America. So you think you're getting the opportunity to buy Amazon in Latin America back at the early stages, because e-commerce over in Latin America has been a little bit slower to adopt compared to like the US and the UK. So it's still quite high growth stages for the e-commerce side of it. And actually, if you look at the fastest growing e-commerce markets out there, if you actually look, Argentina growing 25%, obviously one of Mercado Libre's markets. You've got Mexico, 18%, one of Mercado Libre's markets. You've got Brazil, 17.2%, one of Mercado Libre markets. So you've got 3 of the top 10 growing e-commerce markets covered by this company. They are the dominant player in there, which is absolutely amazing. And the other thing that they've been able to do is, because they've able to beat Amazon in Latin America, the way they've done it is before Amazon could do it, they built up their fulfillment networks, so they have very good delivery. But they also launched a payment platform. They launched Mercado Pago, and this is basically the PayPal in Latin America. Before then, there wasn't really the kind of fintech infrastructure in Latin America, and then Mercado Libre dealt with that. So they went, oh, well, we'll also sort out the delivery. We'll also sort out the Amazon side of it, and then we'll create the PayPal of Latin America. And these combinations mean this company is on absolute fire. If you look at the recent earnings, the recent earnings beat by 0.88. That is scary good. The profitability is ramping up, because with Amazon, we know you have normally lower profit margins with e-commerce, but with payments, it's very high profit margins, and this is why the profitability is exploding massively. And they actually don't guide for profitability as well, and it makes it quite hard for analysts to predict it, and they're not realizing how fast that's actually growing now. Revenue, 32% year over year, unbelievable. You look at total payment volumes, nearly 100% year over year growth. 100% year over year growth on total payments. So you've got an e-commerce that's doing very well, but this payment part of the platform is exploding, and that's why the profitability is so high as well. And this is what I think analysts are really sleeping on. The explosion of growth is amazing. The amount that's going to the bottom line means this stock is going to get very cheap overnight, and the profitability they're going to start throwing off is going to be very good. You're talking probably in a year's time, 1.5 billion in profitability. Now, you look at the balance sheet is actually pretty good for a company that's had to put a lot of infrastructure costs in. But you look at the balance sheet here, they've got 3.3 billion in debt, which is pretty good, 4.7 billion of debt, 3.3 billion of cash, 4.7 billion of debt, which is not too bad. But like we said, they're going to be throwing off probably 1.5 billion of cash next year. So that debt can be paid off very, very quickly, and that profit's going to ramp up massively. I think this is an amazing company, so I'm buying up shares in Mercado Libre whenever they're having a dip. Next one's PayPal. I'll keep this nice and brief because I covered it in yesterday's video and a big deep dive on it, so I'll keep this nice and brief. But I am buying PayPal, as most of you guys know. I think when you're getting a big blue chip company with the track record that PayPal has, and you're buying it at 10 times forward earnings, unbelievable. You're getting this company that is going to go from an EPS of $4.13 to $4.95. The year after is going to go to $5.65. It's going to go to $5.64. You've got a company here that is going to grow 8% this year, which, by the way, look, Yahoo Finance is working again. Let's go. Year after, it's going to go to 8.9%. Let's call it 9%. 9% revenue growth with this big ramp up in profitability. You've got a company that's going to be buying back $5 billion worth of shares on a company that is valued $93 billion. You've got a company that is, if you look on the future growth, with their 8-9% revenue growth, as you can see here, $4 billion in profitability, nearly $5 billion profitability, free cash flow next year of $7 billion, a balance sheet that is absolutely solid, 53% debt to equity. They're sitting on nearly $10 billion of cash. Honestly, this is very rare that I think you see a big blue chip company on this sale like this, and a lot of people are shouting competition out to it, exactly the same what they did to Meta when Meta started dropping competition, TikTok, and look how that ended up. I think it's exactly the same for PayPal. There's enough market share here for PayPal to still grow good amounts in the next few years, drive up that profitability, buy back shares, 10 times forward earnings. It's scary. Next one, Etsy. So I made a video on Etsy on Monday, so that's a little bit more detailed than what I'll do today. But I have started buying some Etsy shares. I would like Etsy to go into the $50 range. So I have bought a starter position and I am hoping for it to drop a little bit. So we'll see if that happens. But Etsy is a company that I think is being misunderstood. And I saw this actually on the comments of my video that I did on Etsy on Monday. I said that this company is obviously a good company that's been growing revenue at good rates. Had a bit of jump in the CV time, so it's going through some tough hard comps, but then it'll go back to growth and the profitability is amazing. You talk about a company that's throwing nearly 500 million profitability. And I said this company is probably misunderstood because it's actually loss making at the moment as it looks on the accounts, but it's not actually a loss they're taking. And I actually saw this on the comments on Monday video, like, what do you mean? It's a loss. I know we don't actually talk about accounts that much on the channel. I think most people come to me for stock ideas or stock news. I don't really go into financials too much on the channel, but I'll go on the recent quarter. So if you go on the actual recent quarter, you can see here asset impairment charges. So you see they didn't have that this year, and this year they're currently having an asset impairment charges. This isn't actually a cost to the business. They're not actually taking this as a cost, but they've got to register this as a loss because of one of their actual investments. And that's how the company actually dips to a loss, you see. So when I say the company is showing us a loss here, they're not actually making a loss. It's actually an impairment charge that's taken on the company. And that's why you just see this little dip here and then it'll go back up to profitability. I know we don't go too much into detailed financials on this channel, and that's going into a little bit more complicated stuff than what I normally cover on the channel, but that's what I mean by that. I know I saw a few people in the comments that were like, what do you mean it's a loss but it's not actually a loss? Hopefully that kind of clears it up a little bit, because I know we don't focus on that too much on the channel. Forward earnings, 16 times forward earnings at the moment, and it's a company that is expected to grow 7% this year, back up to 9% last year. Same again, 9% revenue growth for a company like this, buying back $1 billion worth of shares. E-commerce is still going to grow rapidly, and when you look at the company and they're throwing off around about 300 million this year in profit, but next year back up to 400 million in profitability, that's really good amounts of profit that they're going to be throwing off. And if you can add a good high double digit growth on that with that amount of profitability, buying back those shares, I think it's a good company when you think Etsy has got that niche for where people go to if they want handcrafted products. I think it's got that niche tied down massively and it will do very well in the next few years. The next one is Alibaba. So I did buy some more shares in Alibaba. I've actually been considering maybe selling some like JD.com shares and buying more into Alibaba. But I really like Alibaba at the moment. It's been punished massively on the share price. I actually used to, once again, I actually used to be a 100% club member. I started buying shares in Alibaba when we went through all the Chinese weakness in around about 2018. Shares went up over 100%, sold out about half my position, and since then the shares have been going lower and lower and lower, and I've been buying some more shares in Alibaba because I think it's the king of China. It's going to be a company that does really well in the next few years. And when you look at the e-commerce market in China, it's still going to grow massively. You look at the growing middle class in China, it's still got plenty of good years ahead of it, has Alibaba at the moment. Now, I think people don't realize, like, the companies that Alibaba own, they own nearly everything in China. Like, if you are going to China, you're going to use one of their products, whether that be from maps, social media, buying things, data, health. They own so many little things in here. And that's caused a little bit of an issue because what we saw in 2022 and what's caused the slump in the share price is the crackdown from China. They went, oh, we don't like all this monopoly that Alibaba and Tencent have. We're going to crack down on them. That hurt the revenue, that hurt the profit, as well as that they were a little bit tight on the CV policies as well compared to what we saw here in like the UK and the US. And that's all gone. The crackdown is starting to stop a little bit now. So we're starting to see the financial growth come back. And we've seen that more and more with what they're realizing is, oh, from a year ago, we need to start supporting these companies because these companies are what generates our growth in our economy. We ourselves make less money off them, and the Chinese government want to have money to go do things. They want to go whatever they want to do, spend it on military. So they want more money. So they've realized we need to be a little bit more relaxed on the Chinese companies more and more, which is obviously really good. Alibaba itself are going, right, what we'll do to help you monopoly fears is we'll actually split up our company into 6 different units. Hopefully these 6 different units actually get more value, being individually valued. You know, if you actually just want to own cloud, you own cloud. Maybe that attracts investors in. And you get all that at 9 times forward earnings. You know, you look at the historic, what this company has traded at. If you go back to, 2019, total enterprise value to revenue is 1.7, used to be a 6. You look at EBITDA, it's now an 8 compared to where it was at 2022. It used to be 29 times earnings, and now 11 times earnings. Very, very cheap to what it historically is. And you can see the growth coming back in the business, and you see the profitability starting to ramp up as well. And a really good balance sheet that's actually leading them now to actually do a 40 billion buyback in shares. People always question the cash of these Chinese stocks. Well, there's some of your cash getting to use there. I think Alibaba is looking at very attractive at the moment. And the last one that I bought was SoFi. So I did buy some shares in SoFi. I've been waiting for this to drop. As most of you guys know, I actually started buying this around the $5 mark after it dropped after an earnings report, which was fantastic. The shares went absolutely ballistic, and I was up on these shares massively. Has started to have a bit of a pullback, and I've decided to average up. If I held the shares that I did have, I'd actually be up 63%, but I just keep averaging up, and I wanted to get more towards the $5 range, but I decided if it gets towards the $6 range, that's where I'll buy. And what started happening is it did start touching towards the $7 range, so I thought, okay, I'm going to buy some here, and then I'll wait, and if it does go low, I'll buy some more shares. SoFi basically is a new entry into the fintech space, which is trying to disrupt it, where you get the best products all in one place. So you can see here they offer personal loans, banking, credit, student loan payments, invest, mortgages, loans, credit cards, insurance, travel. So they're trying to offer everything under this one platform. And you can see people like it. People are coming to them. The member growth has been absolutely insane. And people are buying more and more products from them. So what they're able to do here is that they are able to get someone on and use one product. And then what they do is they cross-sell them more and more of these products. And they're able to make more money. And we've seen that growth in the revenue. We've seen the ramp up in the profitability. And we're actually going to see Q4 come profitable. But you can see here the adjusted EBITDA ramp up in profitability as well. And you look at the recent earnings, they were good. EPS was in line. Revenue 37% year over year. They hiked up the guidance as well. Another triple beat here. Absolutely amazing for this company. And the big thing as well that people aren't factoring in with this is that one of the big things that this company used to do, the first thing they used to do was actually student loan repayments. This used to make up a lot of their revenue only a few years ago. And they paused. They lost all the revenue basically from the student loan repayments. And what do you have coming back this year, or next year should we say? Student loan payments. And this could generate a lot more revenue for the company. If you actually scroll down here, you'll be able to see here that in 2019, it says here, student loans actually represented 6% of SoFi's revenue. And it used to do 200 million in student loans repayments. And it actually thinks now it could be even more than that. So you factor in that there's going to be a big jump in the revenue as well with the student loan finance coming back as well in the next kind of few years. And that's actually, I don't think is being forecast at all by analysts. And I know the company isn't currently forecasting it into the guidance at the moment. And that's going to lead to a big bump up in the revenue. So the revenue is going to get a bit more of a bump up. You can see here they are going to cross the line into profitability by the end of Q4. And obviously that'll be a full year in 2024. So the revenue growth is going to be good. They're going to ramp up the profitability. They're attracting new members. With these new members, they're able to cross-sell a lot more of these products. And they should really, really benefit from it. So that's the last stock that I'm buying. Now, I did sell 2 stocks. Obviously, Beyond Meat, which I covered on the YouTube channel. I did take a bit of a loss on, well, more than a bit of a loss, on Beyond Meat. I decided that it's time for me to cut the losses on that one. The company, the financials, the balance sheet's awful. The financials are not improving. The last quarter was absolutely horrendous. And I just think that it's just gambling, basically, hoping for that company to turn it around now. And I don't think they will. I don't think that if we are entering in the slowdown, the last thing people are going to do is going to choose a expensive vegan alternative burger over real meat when the real meat's going to be half the price of the alternative vegan meat. I think it's just, they're in a bad situation. I've covered it all on the channel anyway, already on the video, so I'll keep it nice and brief. I just think it's in a really bad place. And I did sell my shares in Turtle Beach. I think I did take a 30% loss on this one. You guys on the Patreon probably might remember, I can't remember exactly what it was. I think it was about that. It was just a really small position, and I just thought, what's the point of having it? I've already got another company that's very similar to this, and there's no point in me doing the work for this position. Take the cash out, and as you can see, you know, there's all these opportunities starting to appear in the market. If I'm able to buy Hims and Hers and I'm able to get that share price to get 100% return, as most of you guys know, I'm a long-term investor. I invest for 2 to 5 years. I aim for about 100% return on every investment. You know, if that can double up, you know, I can easily, you know, that would be the better opportunity. If Melly does it, you know, there you got PayPal that could potentially do it, Alibaba that does it. You look at SoFi, you know, all these stocks, I'm buying them because I think they have got 100% upside in the next 5 years. So we'll see how they do. And obviously some of them have already done it once, so hopefully they can redo it. That's the big thing. So yeah, hope you enjoyed the video, guys, for the stocks that I'm buying. If you could hit the like button, if you're new around here, subscribe, and I will see you all on Monday, unless you are on the Patreon. I might see you tomorrow. See you in a bit, guys.